Investing can feel scary, especially now when the market's way down. There's fear that's involved. Here's what I want you to understand. It's okay to have fear in times of uncertainty. But what's not okay is to have that fear drive really bad decisions. It's not okay to sit on the sidelines and not invest at all because of your fear. It's definitely not okay to pull all of your money out of the market when the market is down. In this video, I'm gonna share with you a way that you can invest, stay in the market, but have a buffer on the amount of money you could lose, even in the worst markets. Let me tell you what this is and what it isn't. This is not a life insurance product that is masking itself as an investment that, for most people, isn't the most efficient way to invest. This is not some Ponzi scheme or something crazy that people might have lost money on and then their story was told on the 5 o'clock news. This is a way to protect the downside that you might have when you invest. And in exchange, you also have to give up some of the upside you might have when you invest. I think anybody can understand this concept here. If the market is way up, but you only get to realize a percentage of that increase, and in exchange, if the market is way down and you only have to realize a certain percentage of that decrease, it makes sense. Now, I don't want to get into the weeds of all of the details for each of these investment strategies. To be honest with you, it's going to be boring to most. However, if you do want more details or information on these particular investment options, let me give you the names of them so you can Google it. They are called buffered ETFs or structured notes. Those are two products that you can have as investments that can give you limits on your upside, but also limits on your downside as well. Most of the time, it's called downside protection. And that word protection is a big deal, especially for some as they're navigating these current down markets. This type of investing isn't for everybody. A lot of people want the high upside and they're okay with the potential downside. But if you want protection in down markets like we're experiencing right now, and you're willing to trade off some of the upside you could get when the market is up, this could be an investment strategy for you. As a general rule, it doesn't really matter how old you are or what your income or asset level is like. It's more about what happens in your head when the market is down. If you have lots of fear, if you have lots of uncertainty in down markets, this could be great for you. If you're the type of person who doesn't really have a whole lot of fear and you're looking forward for when the market does turn around, this probably isn't for you. The truth is, successful investing is a lot more about behaviors and a lot less about intelligence. And these investment products that have this downside protection but limit the upside, if they're a product that can help ensure you have the right behaviors throughout your investment journey, you should look into it. Talk to your advisor. Ask about downside protection, buffered ETFs, structured notes. These types of investment vehicles can give a lot more peace and certainty even in down markets.